Hi, I'm Tom Lydon in Hollywood, Florida at the Inside ETF conference. And I'm here with Sean O'Hara, President of Pacer ETFs. Great seeing you, Sean.
How are you, Tom?
Recent statistic, advisors surveyed said 70% of them use some type of tactical strategy. I imagine that number had an uptick in this recent volatility.
I would think so, given what happened at the end of the year last year. And we were talking, I was at one of the earlier sessions and they were talking about how stories make more sense today. We're 10 years into a bull market here. So I think people are sort of waiting for the big one, if you will. The last part of last year wasn't even the big one, wasn't even a bear market, to be honest with you. And so there is a desire, especially with people near or in retirement, to have some part of the portfolio that will help them manage that downside risk, and having a tactical story certainly can help.
So you've got this really unique strategy within your suite of ETFs where there's a technical indicator that will go 100% from equities and begin to go into cash. So explain that briefly. It's basically a 200-day average, is that correct?
Yeah, I mean, we didn't invent the 200-day simple moving average as a way to identify uptrends and downtrends in the market.
Yeah.
It's been around forever. There's lots and lots of research and books written on it. Jeremy Siegel in his book, Stocks for the Long Run, wrote about it. But in the ETF wrapper, what's unique about it is that we can minimize the transaction costs and we can minimize the taxation. And so what we do is there's 4 Trendpilot strategies. One tracks the S&P 500, one tracks the S&P 400, one tracks the NASDAQ 100, and one tracks the European index. And all we do is we look at the relationship of the index to its 200-day moving average. If the index is above, that means we're in a positive trend. We own the stocks in the index. But if that index falls below its 200-day moving average, then the portfolio starts to migrate towards treasury bills with an eye on not participating fully in the peak to trough decline in stocks.
So a couple cool advantages here. Number one, from a taxation standpoint, if I'm going to go do that myself and buy SPY and trade it on a 200-day average, I have capital gains tax.
Absolutely.
We're going to pay, my clients are going to pay.
Yeah.
Within the ETF structure, there's a big chunk of that could be avoided, correct?
Yeah, for example, we were last in treasury bills in March of 2016.
Yeah.
So we stayed fully invested in the indexes, large cap, mid cap, NASDAQ, from March of 16 all the way until like October of 2018. I think that's 24, 25 months, and made somewhere between a 30 and a 50% return on those ETFs during that period. And when it came time to reposition that portfolio, we were able to do so without creating any taxable capital gains for the client.
That's incredible.
That's huge.
And then finally, it all happens within a ticker. So a client does not see trades that are going on because they're happening within the structure of the ETF.
Absolutely, and maybe the silent killer of the strategy, in my view, that all what we talked about is great, right?
Yeah.
But for financial advisors who've been doing this a while, when we go through, which we will, that next catastrophic bear market cycle, the hardest thing to do is not get people out. They're willing to get out near the bottom because they've had enough. The capitulations happen.
Yeah.
It's getting them back in that's really hard.
Yeah.
And so having a part of the portfolio that uses this approach to moving people away from risk and into T-bills, but also automatically will push them back into equities when the time comes, when the index comes back above, makes the FA's job a lot easier during those troubling times, because it's difficult to do.
It is. People want to find out more information, where do they go?
PacerETFs.com.
Excellent. Great seeing you, Sean.
Good to see you, buddy.
Thanks, man.